Do you remember the feeling? That cold pit in your stomach in 2008? Do you remember the words subprime, ninja loans, financial meltdown? In 2008, these words weren't just headlines, they were the triggers for a global financial meltdown. A crisis built on a simple, toxic idea: giving mortgages to people who couldn't possibly afford them, packaging those bad loans, and selling them as safe investments. It was a house of cards that brought the entire world to its knees. Now, 17 years later, listen, can you hear it? That same language is back. Affordability, expanding access to credit, alternative data. In November 2025, as the U.S. housing market suffocates from high prices and high interest rates, two massive changes are on the table: a proposal for a 50-year mortgage and a far more immediate shock. Fannie Mae, the giant that guarantees most of the American mortgage market, is officially removing its minimum credit score requirement. That's right, the floor is gone. Millions of Americans, watching their savings get crushed by high home prices and high interest rates, are now hearing this, and they are terrified. Are we just repeating the exact same mistakes that led to the Great Recession? Are these new affordability programs just ninja loans 2.0? This is not a simple yes or no question. The mechanics are different this time, but the risk might be even stranger. Welcome to Finance Prism. We make complex finance clear. To understand what's happening, you first need to know who Fannie Mae is. Most people think they are just a name on their mortgage paperwork. The truth is, they are the market. When you or Sarah want to buy a home, you go to a local bank or a lender. The bank gives you a $300,000 30-year loan. But here's the problem. The bank doesn't want to wait 30 years to get its money back. It wants that cash now so it can make more loans. So, it immediately sells your loan to one of two giant government-backed corporations, Fannie Mae or Freddie Mac. These two giants are the secondary market. They don't deal with you, they deal with your bank. They are the giant plumbing system that buys up loans from all over the country, keeping the banks full of cash. Then, Fannie Mae does something that should sound familiar from 2008. They bundle thousands of these mortgages together, your loan, my loan, everyone's loan, into a new financial product called a mortgage-backed security, or MBS. They stamp "guaranteed by Fannie Mae" on it and sell that to global investors, pension funds, hedge funds, foreign governments. This system is what allows a 30-year fixed-rate mortgage to even exist. But here's the most important part. Because Fannie Mae is the biggest buyer, they set the rules for what kind of loans they will buy. They dictate the entire quality of the market. For decades, one of those key rules was a minimum FIC credit score, typically 620. If your score was 619, the bank likely wouldn't give you a conventional loan because simply they couldn't sell it to Fannie Mae. This rule acted as a crucial guardrail for the entire industry. On November 16, 2025, that rule is gone. Now this is the point where the panic sets in. Is the government forcing banks to give loans to people with terrible 400-point credit scores? The answer is no. But what they are doing is more complicated. Fannie Mae's new policy isn't about accepting bad credit. It's about accepting no credit, or what's called a thin credit file. This is a critical distinction. The new policy is designed for people with thin credit files. Think about it. How can you get a credit score? By having credit, by using credit cards or taking out loans. But millions of Americans, especially young people or new immigrants, are credit invisible. They might be incredibly responsible. They pay their rent on time every month for 10 years. They pay their utility bills. They pay their phone bill. But because none of that shows up on a traditional FICO report, they are locked out of the housing market. Under the new rule, lenders can now use alternative data, often gathered in what's called a VantageScore, to prove that this person is actually a reliable borrower. This model looks at your real-life payment history, not just your loan history, to build a profile. In theory, this sounds logical. It sounds fair. It's helping responsible people who were stuck in a broken system. So if the intention is good, why does it feel so bad? Why does it feel like a desperate move? Because this isn't happening in a vacuum. It's happening in the worst housing market in modern history. It's happening at the exact same time affordability is at an all-time low. And it's happening just as politicians are floating another solution that smells just as desperate: the 50-year mortgage. Are these policies really about helping new buyers, or are they about finding a new source of demand to keep a dangerously inflated market from collapsing? Let's quickly analyze the math on the 50-year mortgage because it reveals the flawed logic of these solutions. You want to buy the median U.S. home for $400,000. You put 20% down, financing $320,000. With a standard 30-year loan at 6.5%, your principal and interest payment is about $2,022 a month. Over 30 years, you will pay about $408,000 in interest. Now look at the 50-year loan. To compensate for the insane risk of lending money for half a century, the bank will charge a higher rate. Let's be generous and say it's only 7%. Your new payment is $1,820. You save just over $200 a month. That's it, a 10.8% savings. But the catch? Look at the total interest. $772,000. You pay nearly double the interest just to save 10% on your monthly payment. You will be in debt until you are 110 years old. But here is the real hypnotic trap. This doesn't actually make housing more affordable. Markets are smart. If you give everyone 10% more purchasing power, home prices will simply inflate by 10% until the monthly payment is right back to the maximum buyers can afford. This policy doesn't help buyers, it helps sellers and banks. It is a mathematical trick to keep prices high, funded by locking a new generation into a lifetime of debt. So we have new policies designed to bring in new, riskier buyers and new loan types designed to hide high prices. This feels just like 2008, but it's not. The mechanics of the 2008 crash were completely different. The 2008 crisis was built on adjustable rate mortgages, or ARMs, and balloon payments. People were given teaser rates that were artificially low for 2 or 3 years. After that, the rates would explode or a massive balloon payment would be due. These loans were designed to fail. Lenders didn't care. They gave out ninja loans, no income, no job, no assets, because they could sell these toxic loans to Fannie Mae and Wall Street, passing the risk to someone else. When millions of those loans reset to payments people couldn't afford, it triggered a wave of foreclosures. That massive wave of new supply flooded the market and prices collapsed. Today's crisis is the mirror opposite. We don't have a supply of bad loans. We have no supply of houses. Why? Because millions of existing homeowners are sitting on what we call golden handcuffs, mortgage rates of 2, 3, or 4% that they locked in during the pandemic. They cannot afford to sell. If Dave sells his $500,000 home, he has to buy a new home at today's 7% interest rates. His monthly payment would double. He is locked in. This isn't a theory, it's a mathematical prison. So inventory is at historic lows. This is the real, fundamental sickness of the 2025 market. So if the Fed can't lower interest rates because of inflation, and existing homeowners won't sell because they are locked in, how do you keep the multi-trillion-dollar housing market from freezing solid? You can't print more houses, so you print more buyers. This new Fannie Mae rule isn't about creating bad loans like in 2008. It's about creating new demand from a pool of people, those with thin credit files, who were previously locked out. It is a desperate attempt to prop up demand to meet today's high prices and high interest rates. But this just pours gasoline on the fire. It doesn't fix the supply problem. It only increases competition for the few homes that are for sale, pushing prices even higher for everyone. But what about that other proposal, the portable mortgage? The idea that Dave could take his 3% loan with him to a new house. Wouldn't that solve the lock-in effect and free up inventory? This idea is popular, and it actually exists in other countries like Canada. But there's a critical difference. Canadian mortgages aren't fixed for 30 years. They typically reset every 1 to 5 years, so the bank knows it will get its money back or be able to charge a new, higher rate relatively soon. Portability isn't the massive risk for them. In the United States, our entire system is built on the 30-year fixed-rate loan. And every U.S. mortgage has a kill switch, the due-on-sale clause. This means the moment you sell your house, your 3% loan must be paid back in full. Who would lose in a portable system? The lenders, the investors, the banks. They are losing billions of dollars right now, holding on to those 3% loans while the rest of the market is at 7%. They are desperate to get those toxic assets off their books, forcing them by law to let you keep that 3% loan for another 25 years on a new property. It's a fantasy. It would be financial suicide for the banking system. This will not happen. You cannot retroactively change tens of millions of legal contracts. It's a logistical nightmare that would require a massive, multi-trillion-dollar government bailout to backstop all those bank losses. So, let's bring this all together. Are we repeating 2008? No, this is a new crisis. The 2008 crash was a supply of credit bubble. Too many bad loans were created. When they failed, supply flooded the market and prices crashed. The 2025 crisis is a supply of housing crisis. Not enough good homes are for sale. The solutions being proposed, 50-year mortgages and no credit score requirements, don't fix the supply problem. They only attempt to inflate demand. This creates a dangerous two-tiered system, the haves and the have-nots. The haves, the existing homeowners locked in at 3%, are fine. Their wealth is protected. They are insulated from the crisis. The have-nots, the renters and the new first-time buyers, are being pushed into a meat grinder. Renters now have to compete with more government-backed buyers, which will only drive rents higher. And the new buyers, the very people this Fannie Mae policy claims to help, are being encouraged to enter the market at the peak of its valuation, with high interest rates and without the traditional safety net of a strong credit history. They are taking 100% of the risk. In 2008, the system collapsed because the loans were designed to fail. In 2025, the system is being propped up by pushing the most vulnerable people into the most expensive market in history. The fundamental problem remains, and these policies won't fix it. We just need to build more homes. This system is complex, the rules seem to change every day, and it's easy to feel like the game is rigged against you. But at Finance Prism, our job is to make it clear. If you want to understand the real forces shaping your money and how to navigate them, subscribe and let us know in the comments. Do you think these new rules are a necessary fix to help people, or are they a dangerous repeat of past mistakes?